Welcome to the last one in the MayJune 2023 paper, the 2-1 paper, and in this one we are going to be looking at companies and particularly the financial position of a company. Companies differ from partnership and other ones in that they have shareholders, and we've got shares, and with those shares we've got issued capital but also retained earnings. They also pay dividends, which is quite important when we're doing this as well. So the company we've got here is called Q Limited, and they've got retained earnings at the start, so that's profits that they haven't paid out as dividends of 16,250, and we've got some information here that are going to help us to do the financial position statement. So no financial position statement, quite easy this one because they don't have any adjustments for us, which is pretty good. So it's just basically doing the position statement. That starts off with your non-current assets. And your assets, with your non-current assets, we've got the cost, we've got the accumulated depreciation, and we've got the book value. I'll just add a bit of space here, maybe call that assets. And that way we can call that book value. So what we're looking for along here is things that are at cost, which is great because I've got two things written at cost. And these are our non-current assets. So we'll put fittings and equipment. And the other one, motor vehicles. Just check that there's no premises in there, because that one doesn't have a provision for depreciation. I can't see any, so we're pretty safe on that. So we're just going to put the figures in of 150,000 and 72. The accumulated depreciation, or they've called it provision for depreciation here, 4650. Pretty lucky we haven't had to calculate these. And the book value is the cost minus accumulated depreciation. Get all those figures in and add those up. Nice and easy. So after the non-current assets, we have the current assets. So looking down here for any current assets, starts off with, looks like inventory, which is good. Doesn't really matter too much what column this one is in. We've got a bank. We're not going to call it bank balance as that, we'll just write bank. And just see that it's a debit. If it was credit, it would be a current liability. So that's a sneaky trick that they haven't done. And the other one is trade receivables, but look underneath that we've got a provision for doubtful debts, so both of those are going to need to go in. So we'll go trade receivables, so based on that they probably do want these two over here, so we can do our calculation. Trade receivables 19,700. Put a minus on that 591, just to remind you to take it off. And our total current assets. So that'll give us the total assets. This figure is a really important one because it's got a balance with our figure down the bottom. Our capital and liabilities is the next section, so we can do our capital first. So the capital, we've got ordinary shares here. So we're going to put those in, and Often it's quite nice if we know how many shares there are, but it doesn't tell us in this question. It tells us 120,000. And our retained earnings, we might have to have a look and see what we've got on this one here. So, got to find the company profit at the start. So we've got a balance at the start. We'll type retained earnings in. So it equals, that's your, don't write it in here because we've got to do a calculation. 433,500 is our opening balance. Sorry, 16,250. So our retained earnings are our opening balance plus a profit minus the dividends we've paid. Right, that's going to be our total capital. And then we do liabilities. We've got two types of liabilities. We do our non-current first. So looking through, non-current liabilities are normally things like long-term loan, mortgage, but I can't see any long-term loan or mortgage here. Yes, we have. We've got a bank loan in there. See, it's long-term because of the date. So we'll add bank loan. What have we got? 10,000. Got another one called debentures. Now debentures are basically a loan to the public. 40,000. Add those two together. And then we've got our current liabilities. These are things that we owe in the short term. And there must be just anything left. It looks like we've got trade payables. Can you see any more? No, everything's used. So just trade payables. 31,450. And then so we're going to add all those up to total liabilities and capital equals moment of truth. And it should equal this figure here. Perfect. Done. So those two balance. So chances are we've got 100% in that. All right, move on to the next question then. Calculate the retained earnings. We've already done that work. So retained earnings. We'll put the formula in again. What do we have? We had 16,250, which is our opening balance, plus the profit of 43,500, minus the dividends of 39,000 equals 2750. Then we're after some ratios here. So the liquid test, or the liquid ratio, two decimal places, that's equal your current assets, but not including inventory, divided by your current liabilities. So we look through our current assets, not including inventory. I'm going to open my brackets. So we're going to put these ones together. So it's going to be bank plus those trade payables, trade receivables, divided by current liabilities, which is that payable there. What figure did we get? 0.64. And the answer is to 1. So it means for every dollar of liquid liabilities, we've got 64 cents of liquid assets to cover it. So we might have difficulty covering our debts in the short term because we've only got 64 cents for every dollar that we owe. suggests two reasons why, although the company made a profit, there is a little money available in the bank account. It's not necessarily about dividends, because dividends are lower than the profit, so that's not too much of a concern. So we need to find other reasons. How come the bank's low? The bank balance is still 107.6. So there is only a little bit of amount. So one reason could be because there's an increase in inventory. So instead of having your current asset as cash in bank, you've got all that money piled up in inventory. And you can see we've got quite a large inventory of 51,000. And also, it might be that your accounts receivable are slower paying. So if you're really looking at this business, you've got 19,000 tied up in trade receivables, 51,000 in inventory. If you're worried about where your money is in the short term, that's where it is. So, yeah, a lot of solutions to get around that. One, you could get rid of some of your older stock, or take it back to the supplier, the trade payables, owe them less, and that would increase that ratio. But let's advise. The advice directors whether to issue shares to fund the expansion or get a bank loan. Let's read about the expansion first. The directors who are shareholders would like to expand the company and wish to borrow $50,000 to fund the expansion. They're considering whether to issue ordinary shares or request another long-term bank loan. All right, so let's have a look at the bank's loan they've got already. We've already got debentures of 40,000, a bank loan of 10,000, so that's 50,000. It's not too bad really, because your ordinary share capital is 120,000. If you add another 50 on that, then your share capital is higher than your borrowing. So yeah, I reckon go for the loan. All right, and we need to justify our answer. So reasons for and against. So for, keep control of the So the current shareholders keep control over that. That the equity ratio is still okay. What we've got 120,000 in shares, and how much is our retained earnings? 20,000. What are the reasons against? Well, could reduce dividend payout in the future. The reason against getting a loan, well, you have to pay interest on loan, and there's already debenture and loan. Yeah, I think that's probably okay. Done. And that's another 20 marks and the finish of the 2023 May-June paper 21. Well done.